Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this week's video I'm going to go over my stock analysis process. So what you'll find, as if you know my channel from previous videos, I kind of feature a lot of Phil Town content. So this is really the kind of analysis process I follow, which is his 4M's analysis, which is meaning, moat, management and margin of safety. So this is actually part of a playlist I've got, so I'm not going to spend too much time on each individual point because I've got more detailed videos on each of the elements that makes it up. So what I'd recommend you do is kind of go and check out the other videos I've made. I'll leave the list of all the relevant videos in the description as well, just so you can kind of easily follow on for the process. So let's get on with the video. So let's go and look at the first one, which is meaning. So for the meaning, we need to see like how we found out about the company. This can be kind of the easiest way to do it is sort of look at companies you're already familiar with products you buy and services you use and things like that. An obvious one for me would be kind of Apple. I've got like a lot of different Apple products, so I use their stuff on a daily basis. I keep an eye on kind of all of their press releases and things like that, and then you kind of have to come up with a story around why the company has meaning to you. So like I've just mentioned, obviously I like the products, I like the ecosystem, and that's kind of one of the reasons why I'd be interested in investing in Apple as a stock. So then the circle of competence bit comes in here. You need to be capable of understanding the business. I mean, for me, I think I can understand Apple. It's kind of not a really complicated business. Obviously, they have hardware and software, and also now moving into a lot of services. As part of their services, they've got cloud, Apple Arcade, Apple News, obviously the App Store, and other subscription kind of things like that. And the key here is that it needs to kind of, with your circle of competence, you need to know what fits within the circle. So you need to know what you know, but most importantly, you need to know what you don't know, because that's kind of the key thing. You need to stay well within your circle and not kind of stray outside of that. And to really get a proper understanding, you need to kind of read the company's 10K, which is like a filing that's released on an annual basis in the US, or the equivalent in any kind of in any other markets. And also look at the financial statements. So this is the income statement, the balance sheet, and the cash flow statement. So that's sort of where we start to go a bit deeper into the research of the company. If the company doesn't have meaning, you don't really need to go any further with your research, because you're not actually going to be really interested to kind of do a lot of research and spend time if it's a company that has no interest to you. So now moving on to the moat. So a moat in terms of a business is a durable competitive advantage that protects it from its competitors. So we need to think about this obviously like the moat on a castle. We're in the castle trying to protect ourselves from anyone attacking. So obviously the wider, the deeper, the bigger the moat is, the more difficult it is for the actual competitors to get into the castle, which obviously in this case is getting into our kind of market and taking our market share away from us. So you will find that the moat kind of presents itself in certain numbers, and I'll go and show an example of this from Phil Town's Rule 1 toolbox, which I actually used to help me with that. So here we are, I'm in the Rule 1 toolbox now. I'll just keep it as it is. The last thing I was looking at was Facebook, so we'll leave it on that, just because this is kind of you will see some interesting scores on this. So the main things I look at from this when I'm going into the toolbox is I want to look at the growth rates of how Phil categorizes it is the moat numbers. So this is book value per share plus dividend growth, earnings per share, operating cash flow, and sales. And based on that, it gives them an overall score. So here we can see that they're all kind of very high for the 10 years, and still incredibly high even in the last few years. So we can see that Facebook's still growing at a really high rate. So you'll find that there's a number of different kind of moats. You could have a brand moat, a price moat, a secrets moat, a switching moat, or also a toll bridge moat. So these are a few of the different kind of moats, but what is really important here is the company that you're investing in needs to have at least one moat. You'll find a lot of companies, really strong companies, they'll have multiple moats. This is also the case, as I mentioned, with Apple. They've got a secrets moat around, obviously, components and software and things like that. They've got a brand moat because they're obviously a really strong, desirable brand. And with that, the kind of important thing with a brand moat is that you can kind of raise your prices over time and people will still pay to buy that product. So this really makes the business inflation proof. So like if Apple's component prices go up, you'll see that they've been raising the price of iPhones considerably, like in the last few years. The same thing with you'll see with Coca-Cola. Obviously, if the price of all the commodities that go into making Coca-Cola go up, Coke just raises the price. No one will really bat an eyelid. They'll just still buy a Coke regardless if it's the price has gone up slightly, because they want to get their Coke. And like I say, you really need to be able to identify at least one moat with a company, because if the company doesn't have a moat, then there's not much chance that it's going to thrive or even survive for very long. So the next thing we'll go and look at is the management. And management is really important as well, because obviously we need a really good management team leading the business, and we want the management team to have integrity and obviously be talented and good at allocating capital as well, because one of the important roles of the CEO is the capital allocation. So we're going to see this reflected in the return on invested capital. So obviously this is one of the key numbers we're looking for here, as well as managing the company's debt. We don't want to see the company taking on too much debt unless it's obviously attractive to do so in kind of like low interest environments, but that's one thing we need to keep an eye on as well. So we kind of prefer it if the CEO is a founder or long-time employee of the business. It just kind of helps us really know that they've got like the best of the business at heart, particularly if they're actually a founder in the business. We also like to see the company having a big, hairy, audacious goal. And we need to see good capital allocation, so that's return on equity, return on invested capital, and also is managing the debt levels of the company. And in the case where there's been an event or like something happened within the industry, does the CEO have any experience of managing the company through that event? It kind of stands to reason that if the CEO has kind of led the company through a problem once, then they'll be able to do it again. So that's really one of the key things that we're looking for with the management. And now moving on to the margin of safety. We've got a quote here from Charlie Munger from a BBC interview in 2009. "No matter how wonderful a business is, it's not worth an infinite price. We have to pay a price that makes sense and gives a margin of safety considering the vicissitudes of life." So obviously what Charlie's saying is very difficult to predict the future. A lot of things come around that can't be anticipated. So we need to be buying with a large margin of safety to actually protect us from any errors we make when looking into the company. So we'll take a look at a few of the key points with the margin of safety. So predicting the future is very difficult. So we need a buffer that's going to protect us from any mistakes in our thesis on the company. Ideally, we want to be in a situation where even if we get our kind of valuations or our kind of thesis of the company very wrong, we can still actually get out of that without losing money. So this is why we kind of demand a large margin of safety, looking for something around the 50% mark. So obviously the key thing here is we need to work out the valuation, because without knowing the value, we don't know what we're going to pay and what's a reasonable margin of safety. So this is where the valuations come into play. So Philtown uses 3 different valuation methods, which is the margin of safety, which is like a discounted cash flow, but using the earnings per share. And also he has the 10 cap price method, which uses the owner earnings, and the payback time method, which uses the free cash flow. And he actually has calculators on his website as well. So I'll leave links to all of that stuff for you to go and check it out as well. So just go and look here. We've got the margin of safety calculator for Facebook. We have to plug in some numbers that we've done from our own research. This future growth rate will be the kind of consensus from the analysts, which is 20%, but I don't think it's realistic to expect that Facebook can grow 20% compounded for the next 10 years. So I'll just change that just quickly, just to see what we get. And then with this, you normally double the future growth rate to get the future PE. This is our minimum acceptable rate of return. We need to be making at least 15% each year. We want a 50% margin of safety on that. This is already added in the free cash flow per share, which is what's going to actually calculate your payback time price. So let's just submit that and see what we get back from it. And obviously all of this should be based on the research that you've done into the company, the financial statements, the growth rates and things like that, reading in the 10K. But just for the purposes of demonstration, we can see here that stock price currently 315.94, PE ratio of 27. So we can see what we've got here is the sticker price, as Philtown calls it. So that's the intrinsic value of the company. Is 350. So actually at the moment Facebook is still kind of slightly under the intrinsic value based on our calculation here, but obviously if you want to get a 50% margin of safety, we need to be buying the shares at the 175.20 price. So that gives us that's our margin of safety price, which we need to buy. So you can see here the stock price is up here. We need to buy kind of down at the 175 mark to be able to buy within our margin of safety. And also the payback time price, the current price is 11 years. So to get the 8 years required for Phil's like payback time, it needs to be 172.54. So that would be the payback time buy price. And the margin of safety from the payback time actually comes from the fact that normally in a public business, we're prepared to get our investment back in free cash flow within 16 years. So this is why Philtown wants to get it back with 8 years. So the 16 to 8 is the 50% margin of safety here. And that's because that's what is expected normally from his research in private equity. So in private equity, we'd expect to get our money back off the table within 8 years. So this is what he wants to do with a public company. And remember as well, a public company is more liquid, it's easier to get in and out of, rather than a private company which probably behaves slightly more like real estate. But anyway, I thought that's kind of just to show you a quick demo of that and what you can get if you sign up to the Rule 1 Toolbox, which is, I believe, $30 a month. And with these 3 different valuations, we can actually start buying as long as the current valuation falls within one of these 3. So this is the point where we can actually start buying into the stock. So this is kind of a very brief overview of those 4 M's, the meaning, moat, management and margin of safety. So now we kind of, we found a company with meaning, we've looked into the moat, we've checked out the management, we've calculated what our buy price would be for the company, so that's kind of got a margin of safety within it of 50%. The different valuations kind of calculate that slightly differently, but I've also got some videos on those valuation methods which goes into more detail as well. And now we've kind of got to the stage where we're pretty much ready to buy, but we just need to do what Phil calls the inversions and rebuttals. So the inversions and rebuttals are there as part of a final check to make sure that we're certain about investing in the company. We need to make sure that we're not suffering from confirmation bias, because obviously if we're spending a lot of time researching the company, we're going to start really liking that company. So we might kind of get to the stage where we can only see good things about the company. So this is where we have to then list 3 reasons why we shouldn't invest in the company. So we actually start to think of the risks a bit more, and then we need to counter these arguments with factual information about how the company will overcome the inversion. So that's the rebuttal part. We have to rebut those claims, and obviously we don't need to invest if we're not certain. If we're uncertain, maybe it's a company that's going to be better to stay on the watch list while we do a bit more research and maybe broaden our circle of competence there. And finally, once we've done all of that, we just need to wait for some kind of event that's going to put the company on sale. So great companies are not just going to go on sale without anything happening. We need an actual event to put the company on sale. Events will normally create panic among investors and cause the price of the stock to drop, because a lot of investors are kind of getting panicked and fearing that the stock's going to drop even more, so they're trying to get out at a certain price, and this is obviously causes the market to drop. We saw this in March last year when the pandemic first hit, before the government kind of quite quickly came in with their stimulus package, because the stock, I think, was around about 30% or so that it had dropped. But then the Fed came in and obviously shored everything up with the economy at that point. And there are a number of different kind of events. It could be an event which is specific to the company. So you'd see that in the case of the E. coli outbreak at Chipotle a few years back. That's actually specific to that company. And then you'll also see kind of industry-wide events. Obviously, there was the BP Deepwater Horizon. That was a specific event for BP, but obviously it had a knock-on effect of the kind of oil and gas industry as well. So it was sort of taking a lot of other companies down with it who weren't even involved in that particular incident. And then you get the macroeconomic ones, which is like the global financial crisis or the pandemic hitting. Obviously, that's kind of an event which brings the price of everything down. So that's kind of the best one, because then there's not really a specific problem with the company. It's just a general problem everywhere. But the key to the event is that we're certain that it can be fixed within 3 years. So the company is only going to suffer kind of negative consequences of the event for a maximum of 3 years, and then they're going to be able to fully recover. It's possible, if the event is really extreme, that the company might not even recover from it, and that's what we need to be certain of when we're doing our research. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel if you haven't already, and click the notification bell to get notified when I'm releasing new videos. Also, leave any comments you've got. What sort of process do you follow for your stock analysis? Like I said, with me, it's very kind of influenced by Phil Town, just because I've read all of his books. I kind of follow him quite closely. I also did his course as well, which I'll leave a link to the review as well in that. But yeah, that's kind of my way I go about it, just because it's kind of quite a simple process to follow. I'm sure this is probably going to evolve over time, but this is the kind of way I'm doing it now. So thanks for watching, and I'll see you in the next video. Cheers.